Welcome back. You're with us on Trading Hour, and Ajay Srivastava is with us now on the show. Of course, he's CEO of Dimensions Corporate Finance Services. Thank you very much, Ajay. Great to have you on the show as always. So the policy has come and gone. Absolute quiet, non-event sort of a policy this time around. But, you know, the market's in a bit of an interesting space, right? We've got the benchmark indices very close to all-time highs. And it just seems like maybe large banks want to now join in. Your thoughts first, I mean, if there were any takeaways from the policy, and then how do you feel about the market right now?
So I think one is very clear. Here was a man in command. I think this was the first time you see an RBI governor using such humorous euphemisms about elephants and elephants going to the forest. And that tells you the state of the mind of the person, that he is in command of the situation. He knows what he's done. He's done a good job. He's got the exchange up. And he is now got a little help from the government on the oil price cut at this point of time. And therefore, he is now saying to the ring, let's keep it. Let's not disturb anything what is there. The status quo continues, and hoping the fact that private capex comes in. And as regard banks are concerned, I think it's a sweet spot now, because with the reduced borrowing by the government of India, which has been come out in the calendar, there is now space for the banks to now start to lend out compared to keeping reserves and buying securities. So all in all, I think it's a commanding performance of an RBI governor in complete comfort and control of the situation on the ground. And that gives you almost, it's like Zen-like comfort. You know what I mean? Zen-like comfort to say, all is well, guys, keep buying shares in the market and I'll look after you.
Okay, and where do you have a Zen-like comfort in terms of the themes? You spoke about banks. What else?
See, very simply, the defense stocks continue to be the darling, because as time goes by, they are seeing greater and greater traction, and we've seen that happening. So I think, you know, no difference in what's changing in the market. Whether it's the hotels, the consumption story at the upper end, the hotels, the airlines, the defense stock, the capex good, I think the same continue. And what not to buy also continue. You don't want to buy a theater company, nobody wants to go there. You are a little worried about the chemical companies. They are facing a global upheaval at this point of time. Agrochem companies not good favor at this point. So I think, you know, it's amazing that you don't need to change your investment philosophy over now almost a year and a half, 2 years. You know what the bad guys are, who's not going to give you return. You know the good guys are giving you fantastic return. Keep away from large consumer companies. They may give you return, but suboptimally. So don't change the themes. That's what I said. He said status quo. Your portfolio should be status quo and add on to it.
Okay, so don't fix what ain't broke, right? I guess that's how they put it. But the only, you know, maybe counter question that we can think to that is whether prices are now already baking in the best possible scenario, or whether, you know, the going is so good that earnings will keep supporting this move. So let's talk about, you know, some of the consumer discretionary plays, Ajay. You mentioned, you know, hotel stocks, travel stocks, etc. Even, you know, things like real estate, discretionary consumption, jewelry stocks. What's your sense there in terms of, you know, the price that you're paying versus the value that you're getting?
You know, price you pay is not necessarily a function of EPS, P. It's also a function of your state of mind. You know, the day you feel positive about life in general, you feel, you know, you can rule the world. The day you feel negative, even the best shares looks awful at this point of time. I think it's the consumers in India are willing to pay for it, and the credit card outstanding and the loans are showing that they're willing to borrow to pay for such services. On the other hand, the investors are comfortable holding long-term stocks in a long term. You know, let's say hotel stocks. Now we're talking of a trajectory of an industry which is going to treble in size in next 3 years. We're not talking of 10, 20%, talking of the hotel numbers to go up by 2 to 3 times in 3 to 5 year framework. In that perspective, I think you have to be patient with your stocks and look at earnings. Of course, why did I say chemical companies I don't want to buy? Because still the earnings is not good enough. But these are stories which have monopolistic element in them. You can't recreate locations, you can't recreate hotels, you can't recreate retail, you can't recreate a Zomato at the end of the day, you can't recreate these things. And I think those stories have a better traction. So earnings do matter, and they will matter, and you will have correction in the market. But the fact remains that if you look at a plot of 3-year trajectory, all these industries stand to gain, because competition is not there, or in the ferocity is not there. Unlike spaces like, you know, whether you talk of bulk drugs, etc., where you compete with China and others, Here, you don't compete with anybody. You compete with Indian companies at the end of the day. So I think, roughly speaking, earnings do matter, but state of mind is, I think, more important. And RBI governor, after seeing him, you should be also Zen-like to say, bad things will happen on a bad day, but ultimately will come out prevail.
You spoke about Zomato, Ajay. So I wanted to get your thoughts in on Zomato. Here, the play has now become more of Blinkit. Because every day Blinkit is adding more categories, new brands, and it's not now competing with a Swiggy. It's practically going to compete with an Amazon and Flipkart. So the addressable market, the TAM for Blinkit is only getting bigger and bigger. In that context, where do you stand on Zomato? For the next 4 years, is it time to look away from the investments, what the bottom line does? Because this is a company where the TAM it's a blue sky scenario.
I don't comment on stocks because but I happen to hold it for disclosure purpose. I've held it for over a year and a half, I think, at this point of time. And therefore, I would say that the same reason applies to it. It has the best thing in the market. It's a first mover advantage. And if it can, and it looks like it has already done all the cash loss business. Amazon is a lousy company in India which makes cash losses. You don't have to be a smart guy to sell 4,000 crore and lose 3,000 crores. You got to be dumb about it. And I think that is where we are going to score. That our Indian companies are doing a lot better because they know the value of money. So when they compete with Amazon, they got a great advantage is that there is a management sitting on one side which doesn't mind losing almost 60% of sales as the losses in the company. Here is a company which is now built up, done the losses, and is adding on slowly the trajectories. In the scale, can you imagine a scale of India, 1 billion people? Just think of it and your mind rocks. So I think you may have corrections, you may have stuff happening, but I can tell you one thing. These Indian companies are going to rule the roost and you will find the imports going away. And it's a sad story because what happened in banking, and my first job was Citibank. Citibank introduced consumer banking in India, but couldn't handle the competition. Well, guess what they did? They sold the franchise. Now, you got to be thinking really dumb about it, right? But that's the way the American companies work. And I think that's true for whether it is going to be Amazon or it's going to be Flipkart. I think they will see serious competition and these guys will rule the roost ultimately because I don't think Amazon understands what retailing is all about. In India, at least, you can't be losing this kind of money on a franchise this strong.
Speaking of banking, Ajay, final question. What weight do banks have in your portfolio? I'm talking about the top tier banks. Because that's where there's a huge debate about whether margins can be as good as they've been. I mean, whether we're pretty much at the peak in terms of asset quality, margins, growth, and whether it goes downhill from here. I mean, where do you stand on that? And what positioning are you giving banks in the portfolio?
See, we brought in banks in our portfolio. After about 2 years, we had zero outstanding to banks. We brought in the portfolio less than about a month and a half back. It doesn't have a very heavy weightage. It's got about, I think, 10% at this point of time, or maybe less than 10%. But we are increasing our weightage in banks for two simple reasons. I think one is that thanks to the political stability, which is now going to be post the elections, you should see a lot more initiatives coming and government borrowing should go down, which gives banks a lot of leeway to play around in the market. Number two is now the RBI stance is clear. They will very tightly control NBFCs. NBFCs and fintechs were eating the so-called cheese of the bank. And I think that movement has stopped. Whether it is deliberately or whether it is by accident, the fintech revolution in this country is now slowly grinding to a halt till RBI clears the regulatory. And investors are very wary of putting money in NBFCs and crowd. Which gives what? Which gives banks the space now to come back and maybe tie up with NBFCs, buy up fintechs, and so on. So our rationale was raw material of money was expensive. They were competing in a market they did not know how to compete with. Thanks to regulatory action of RBI, that format has changed. Banks have got primacy in RBI's views. NBFCs are lower in the category. Fintechs are still lower in the category. So I think roughly speaking, competitive scenario for the bank has changed dramatically in the last 3 months. And that's what's changed our stance to get into the larger banks. See, smaller banks will do well. Some of them will do well, but the risk inherent in a small bank instability are high. So look at just top 2-3 banks at this point of time, including top 3 nationalized banks, and you're good in the portfolio at this point of time. Even a bank nifty index is good in the portfolio because you cover most of it. But the key issue is competitive landscape change has made the change in our portfolio allocation.
Ajay, great conversation. Thank you very much for joining. Enjoy your weekend. We will slip into a break on that note. We'll come back, discuss market technicals. Mitesh Thakkar will join in on the other side.